In recent days, we've seen a dramatic sell-off in the S&P 500. This sell-off in the S&P 500 has precipitated a equally savage sell-off in the Australian equities market. Many have said that this sell-off in stocks suggests that the US is going to go into recession. But when we look at the data of what's actually happening in the US economy, it seems to say entirely the reverse. It seems to suggest that the sell-off is a machine trading event rather than an economic event. The reasons for realising that the US is not going into recession start with the actual employment number that was released. The number was for a lower than anticipated 114,000 jobs in the US economy for the month of July. This increased unemployment to 4.3%. Very interestingly for us, it generated a year-on-year employment growth for the year to July of 1.6% for the US. And the reason that 1.6% stands out in my mind is that 1.6% is the average long-term growth rate of employment in the US economy. So that rather than suggesting the US was going to go into recession, this slightly weaker than anticipated employment growth merely suggested the US economy was growing a trend. And trend growth rate is far, far stronger than recession. We can also look at that by looking at another indicator which we've been using for a long time for the US economy, and that's the Chicago Fed National Activity Indicator. This was released for the month of July, just a few days before the employment number. For the month of July itself, the Chicago Fed National Activity Index, which is a broad measure of the US economy, came in at 0.05 for the month of July, which is as close to zero, that is to say long-term trend, as you can probably get. So again, just like the employment number, the data suggests that the US economy is growing a trend, nowhere near recession. What we do is we generate a model of the US economy, year-on-year growth rate of the US economy, based on the Chicago Fed National Activity Indicator, but not just the monthly level, but the 3-month average of that number. The 3-month moving average for July was minus 0.01, that is to say, even closer to trend than the July number on its own. When we put that into our model of the US economy, it tells us that year-on-year growth rate for the third quarter in the US economy, that is to say, the third quarter in comparison to the same quarter a year ago, we could expect 2.4% growth during that period. Again, nothing like the growth rate which would indicate a recession. Again, the US economy is growing at average growth rate. The final number is the most recent release by the Atlanta Fed of their GDP Now series. This tells us what the Atlanta Fed expects growth to be for the third quarter, that is to say the third quarter GDP annualised. And the number they published on the 1st of August was 2.5%, which is remarkably close to our own estimate for the year-on-year growth rate of 2.4%. So if we look at the employment number growing a trend, the Chicago Fed numbers suggesting the US economy is growing a trend, and the Atlanta Fed numbers which suggest that the US economy is growing a trend, all of these are numbers which show an economy far, far stronger than one which is teetering upon recession or is feared to go into recession because of the sell-off in stocks. So what we think, in short, is that the sell-off in the US stock market is a machine trading event. It has happened because of the triumph of artificial intelligence trading stocks. and is not related in any way to the US economy. That is to say, it is not. It is a machine trading event, not an economic event.